Hello, I'm Caitlin Fitzpatrick with IMN. On behalf of our team and the Fixed Income Investor Network, thank you for joining us for this panel at the Distressed Credit and Asset Performance Update, sponsored by Solve Advisors. Throughout today's session, we encourage attendees to pose questions to our panelists through the Q&A radio button at the bottom of your screen. If there's anything you missed during today's program, this content will be available for viewing on the IMN website after the program has concluded. Now I'd like to hand things over to our esteemed speakers on the CLO Task Force Market Recovery Panel, led by Dan Wahlberg.
Caitlin, welcome to the CLO Task Force on Market Recovery. My name is Dan Wahlberg. I'm a director at Eagle Point Credit Management, and I'm also the chair of the CLO committee for FIIN. I'm joined today by a bunch of esteemed market experts to talk a little bit about what the market's like today, especially in light of the significant recovery we've seen over the last 6 months or so. Perhaps best, let's go around the group and give everyone a chance to introduce themselves, starting with Vedanta, if you don't mind.
Yeah, sure. Thanks, Dan. So good morning or good afternoon, everyone, based on whichever part of the world you are joining from. My name is Vedant Bakshi. I'm a portfolio manager in Commerce Bank's investment office, and we invest in the senior tranches of CLOs.
I guess I'll go next. Hey, everybody, my name is Pramit Mukherjee. I am the senior analyst and portfolio manager at Converge Re, which is a life and annuity reinsurer. I've been in my current role for over 4 years at this point, and also been a major participant in the
Kamal?
Yeah, so my name is Kamal Shehzad, and I work with PineBridge Investments, and our team is responsible for investing in CLO tranches issued by other CLO managers, and I am the CLO tranche analyst for the team.
Hey guys, I'm Joe Trunzo, head of CLO documentation at the Carlyle Group. Our team invests also in third-party managers. We buy equity tranches, and we also participate in mezzanine debt. And I also do a little bit of work on the CLO issuance side here as well.
Great, thanks, guys. So yeah, let's kick it off and just talk a little bit about the market's recovery and what we've seen over the last 6 months. Basically, since a lot of the vaccine rollouts have been coming out, I think we've seen a really robust rebound in not only our markets but generally across the financial space. Maybe we'll start with Kamal. Tell us a little bit about how you've seen CLO performance over maybe the last 6 months or so, and how maybe some of these lessons or the current market affect the way you're looking at CLO tranche investing today.
Sure. Credit markets, generally have come a long way since, sort of the lows we saw in 2020, and obviously CLOs are no different. We have seen, improvements in CLO technicals, liquidity, but I would say most importantly, and this is where I would like to focus most on, is CLO fundamentals. So, we saw sort of recovery caught between May of 2020, when I would kind of say that was the lowest point of CLO fundamentals. Between January, it's almost been sort of a validation for us in terms of the robustness of CLO structures. So, one of the metrics that we as investors, and I would just use it as an example because it is one of the metrics we use for a high-level sort of analysis of a CLO, and also as a comparison metric. It's called the Junior OC cushion. Feels like an all saying it's not, but it's a good starting point. And those have improved between May of 2020 and call it January this year, between 100 to 300 basis points, depending on sort of the vintage that you're looking at. And obviously that's been for several reasons. There's been positive rating agency action, so loan upgrades. There's been cash flow diversion from the equity tranches towards buying more CLO collateral. But I would say the most important factor is actually the active management or sort of de-risking by CLO managers. So first thing, and this is kind of sort of to also highlight how CLOs have this sort of built-in fixing mechanism, and that's worked well. We've seen that it's almost like a case study. most deals ever at cash flow around the July payment. And that's when, performing loans were still sort of trading in the low mid 90s. So obviously a big opportunity for managers to build par at the time. And if they were sort of caught in that cash flow diversion. And also I would say that it all kind of depends on who the manager is. And that's where we find most comfort in, CLOs investing, because these are actively managed vehicles, and a manager can, add value by, appropriately risking or de-risking the vehicle, build par, avoid defaults. And they just need to have the right experience to do so. So when diverting cash flows, identifying opportunities that were performing loans still in the low 90s, I mean, that's a great opportunity. So, I mean, for all these reasons, we as investors are sort of comfortable in analyzing and investing in CLOs, even in markets like, Q2 of 2020, because again, like as I've mentioned, CLOs have this sort of built-in fixing mechanism, and obviously that has a huge impact on recoveries. And obviously all of us have kind of seen that play through.
Yeah, no, I mean, that's incredibly great points. I mean, when you start to see distress and, you start to see research and rating agency modeling and projections, they don't take into account the savviness of experienced CLO managers. And obviously throughout the downturn, the fact that CLO OC cushions were mostly maintained at least above failing levels kept a lot of people currently paid, even though that we were in distress. So, great points. Pramit, maybe turn to you a little bit. I know that you have a specific view kind of on the insurance investor side and how they're thinking about things. What makes CLO investing interesting right now? How do you see interest building up in the coming months now that the market has come back to, let's say, more of a pre-COVID level?
Yeah, thank you, Dan. So obviously CLO investing has been quite attractive, especially for life insurers. And there are many reasons for that. Overall, like life insurers still have a very low allocation to CLOs, if I should say. According to NAIC, it's probably 4 or 5% of the portfolio, right? But the insurers are faced with the downdrift in their overall portfolio yields, and it's sort of mismatched with their liabilities. So the liabilities, obviously, you have features like rate resets and other type of policy behavior, which makes liabilities costlier, in today's rate environment. So obviously you need the book yield to support your liability. So that's where, CLOs are so attractive. And the second aspect is the floating nature. Floating nature is extremely important. I briefly talked about, rate resets. So as the economy recovers, obviously at some point, next 2-3 years, with your policies maturing or, reinvested, at that point, your rates might reset to a higher level. So if you have mostly a fixed book of business, or rather like a corporate bucket, it'll be a pure mismatch. So that's sort of in a nutshell why CLO investing is very attractive. The second part, why is it, what sort of the outlook going forward from now? So the COVID-related crisis or downturn, whatever you call that, was a great test for the CLO market. And as Komal said, the loan market held together well, and the CLO managers, they did exceptionally well to manage the overall structure, collateral, and the senior bonds. So that's it's withstood the test of time. It has withstood in a great financial crisis, although a different vintage. But even going forward now, there was a lot of concern about call-like features or other, structural protections not granted to, let's say, BBB investors. But all those concerns sort of got answered, during this crisis. And I do see life insurers becoming, even more active in the CLO space. They're active not only just as senior bond investors, they're also active in the mezzanine and equity. I'll probably allude to them later in the discussion. But the bottom line is it is an extremely attractive asset class, both based on from a risk-adjusted return as well as asset liability management and managing your cost of funds or your liability yield. So I honestly see the allocations increasing going forward.
Yeah, no, that's great. I mean, you've seen a ton of interesting research about, is cov-lite a good or a bad thing, especially when you pair it with just the increase in liquidity in the loan markets and, the way that CLOs trade. it's very, very interesting how well they were able to weather the storm, and you know, Kamal talked about self-curing mechanisms and stuff like that. You know, Vedanta, I know where you sit, you see kind of a global standing of a lot of different things, and not only in CLOs, but obviously in a lot of corporates and places like that. Just curious, you know, what corollaries do you see in those markets to what's going on in the CLOs? What kind of lessons do you think in the US CLO investing market we should draw from what's going on over there? Any insights you can share from where you're sitting?
Sure, absolutely. Thanks, Dan. So we invest in both European and US CLOs, and given this panel is pretty kind of broad-based, I will try to give more of an European flavor to you know, kind of the discussion out here. Middle of last year and late last year, when I was being invited to participate in panels, one of the recurring themes was CLO 3.0. I don't think we will see any CLO 3.0 this year. It will be a CLO 2.0 all through when we speak on panels this year. Because look, I mean, when as an investor, we look at any CLO, we look at the structure, we look at the underlying collateral, we look at the loan documentation, and then we look at the manager performance and manager style, right? And in the immediate aftermath of the crisis, we saw a massive change in the structure and the collateral. So if I just take the structure per se, a lot of the warehouses which were being termed out in May and June and even July, August, these had a lot of the troubled names within them, names from sectors like airlines, tourism, event management, entertainment, cinema chains, etc. Right, and the rating agencies had come out with very specific views on these sectors. Some of them had actually identified these sectors, and because of that, some of those old warehouses which were being termed out had very high par sub. So in Europe, for example, we saw even 46% par sub for the AAAs in a lot of those structures. And then the spreads were, they started from 200 basis points at the AAA, going down all the way to around 140 till end of Q3. But then we saw a massive market recovery as the news of the vaccine came in, things started becoming more clear. And as Komal referred to the fact that we invest in these structures because of active portfolio management of the managers. A lot of the managers traded in and out of those structures. And within Europe, what we are seeing is the credit enhancements at the AAA levels are coming down from the 46, 45% at the peak down to 38% now. And I've even been sounded out on 36, 37%, which is definitely kind of on the lower side. The other thing so this is a big, this shows that the market is recovering and there's an appetite. And the second thing, which is obviously kind of feeding in, is the concept of the spreads. So the spreads have tightened massively. So we are seeing both in US and Europe that, and I will talk mainly about the senior, talk about the spreads at the senior part of the cap stack. So at the AAA level, they have tightened all the way from 200 to 77 was the tightest print in Europe recently, and in US at the AAA level, you saw a lot of the spreads going down to below 100. So you can see that there's a massive amount of appetite for these structures. And as Pramit referred to the fact that these are based on the interest rate is obviously floating, right? So that kind of bakes in the function, the construct of inflation as well. So this is getting reflected very appropriately within the structure. So all in all, there is more appetite for this product, which is leading to the market recovery. Would it sustain? I think we have seen a fair bit of tightening across both the structures and the spreads, and somewhere through maybe at least Q2 and Q3, I would see the same kind of structures with possibly more spreads being offered all through the cap stack. It is being reflected at the single Bs and double Bs right now anyways. So I think at the senior part, this will start widening as well.
I mean, that's obviously terrific color. And, you know, we're seeing the same thing in the US, certainly in debt spreads from where they were last year to where they were today. We've seen kind of a commensurate tightening. especially, somewhat in the beginning of this year as things have come back together. And with that, this is kind of a perfect segue for us into what's also been a big topic in the CLO market, which has been refinancing and reset transactions. Since we haven't really seen AAA levels where they are since maybe early 2018, where they've kind of been touching today. Maybe I'll turn to Joe with this one. Maybe you can give me a little bit of color as to what you guys are seeing at Carlyle as both an issuer and an investor this year in refinancing and reset activity, and maybe a sense as to where it goes from here. It's certainly been a very, very busy first quarter.
Yeah, no, thanks, Dan. That's absolutely right. No surprise to anybody how busy we've been on both sides of the house. On the issuance front with new issue and resets and refis, as well as just the volume of deals that we're seeing opportunities to take part in. Really piggybacking on what was just said, I think the reason you're seeing this call it refi or reset wave right now is the perfect marriage of two things, right? It's spreads tightening materially, and there being a tremendous amount of callable deals out there right now. Touching on what you said, 5-year AAAs coming inside of 100. The last time we were there was 2018. That was up against post-crisis tights, and so that just kind of shows you how far we've come and how quickly it's happened. So we have spreads moving in the right direction, and again, a lot of refi and reset eligible deals out there. When you begin to ask yourself, well, why are there so many deals out there that seem to be in the money and ripe for reset or refi? Well, I think the answer is complex, but it should be pretty obvious. And we had a similar reset refi wave in 2018. About $120 billion worth of resets sitting in 2-year non-callable paper. All of a sudden, those deals become callable in 2020 in a market where there's really not anything to do or anything to get done. And so, you have subdued activity in 2019 because, everything that could have been done in 18 pretty much got done. Then you have, little to no activity at all in 2020. So, you walk into 2021 with a lot of deals that are callable, just kind of waiting on spreads to come in to make sense. And then, boom, January 2021, spreads begin to gap in. A lot of these deals are in the money. And I think that's what you're seeing with this explosion. As far as sustaining and maybe where we go from here, not to constantly make the parallel to 2018, but I think we may see something similar where, spreads tighten to start the year. You have a reset or refi wave kind of through this April payment date. Then supply starts to push spreads wider throughout the year, but, still at attractive enough levels to get deals done. The supply is going to be there. Whether or not it makes sense to do reset or refi, really, I think it'll depend on where, what vintage your deal was done, right? Because I think as, there's a slight bias maybe towards refis right now as spreads are moving wider, because you can get a refi done pretty cheaply. You don't have to put in any new equity, starts to look compelling. But, as those, 2020 summer of COVID deals come out of their non-calls in July, I think those would actually be very interesting to look at from a reset level, because, they have 2 years of reinvest left. Initially those deals were probably structured with a lot more credit enhancement than is necessary now. So you probably won't need that equity injection. You won't need to pump in that money. And so I think that kind of should show where the future will be. Steady supply, spreads widening, and sort of, your vintage determining whether a refi or reset is more attractive for you.
Yeah, no, those are very good points. And certainly what I think we've seen happen towards the end of this first quarter. What I think it'll be interesting to see is the beginning of this year, you saw CLO spreads tighten faster than loan spreads. Since, Joe, you touched on how much was callable in CLOs versus loans. As more loans become callable and that market heats up, I'm curious to see if that has any effect on pushing CLO AAA spreads tighter again, because the point you make is clear. It's about arbitrage, and as long as things are in the money and worthwhile to do, guys are going to hit it as many times as they can, for sure. I'm curious, Kamal is kind of an active investor, analyzing this, let's call it an onslaught of opportunities. How do you guys kind of wade through the pool of shorter refis, longer resets against the new issue pipeline you've seen today?
Sure. Thanks, Dan. Yeah, I mean, it's quite interesting right now. I mean, as an investor, definitely, we just feel inundated by the amount of supply that's out there in the market right now. And I mean, a lot of it is refi reset supply, and we all understand that that's not net new issuance. And the appetite for CLOs, you know, as we've all discussed so far, it remains strong, but it still makes it very difficult to focus on each deal. And there's so many deals out there, you know. So while I think spreads shouldn't be pressured, should remain range bound, given most of the supply is refi reset, it just makes it hard to focus. And on the margin, it causes spreads to leak wider. Now, I mean, in drawing some comparisons, you know, between 2018 and now, because obviously we did have similar sort of refi reset frenzy going on in the market, but there's also some things that are quite different this time. And just comparing refis versus reset, my feel is that back in 2018, you know, the sort of the spread duration curve was steeper, and it was actually sort of a question between, you know, if managers wanted tighter liabilities or pay up to extend deals. In this market, we're not there yet. I mean, it's not, the duration curve is not as steep, and it almost feels like, you know, looking at the pipeline of deals that are in the market for refi, and also the ones that have, you know, recently priced, it just feels like most of those deals are the ones that are actually not able to reset and extend, either because, you know, there's not the entire stack is in the money, or it's because some of the mezz tranches have experienced trading downgrades and there's not much that can be done to those tranches. Or it's just purely, you know, it's something like Joe mentioned, that you need more equity to kind of bring back par sub levels to a certain threshold level. And that sort of equity injection is not on the table. But apart from that, I mean, the basis between shorter refi and reset, it's not where it was in 2018, in my experience. And then coming to reset, I think that's also an interesting story. Back in 2018, there was such a strong appetite for paper. And, you know, everyone wanted to kind of deploy cash as soon as possible. And we have these shorter price to close windows for reset deals versus new issue deals, are typically 6 weeks from price to close. There was this very strong demand for reset paper. Also for another reason that, you know, I experienced myself as an investor back then as well. You had a lot more visibility into reset portfolios because those are already fully ramped. So, you know, you kind of knew where the stresses were, and a lot more visibility pretty much versus ramping a new deal. But in this market, that's very different. I've seen that investors are not as asked to buy reset paper compared to new issue, and it's for a variety of reasons. I mean, the strongest demand right now is from banks and insurance companies pretty much, and they're looking for these sparkly clean new issue deals that have absolutely no hair in the portfolios, cleaner documentation, you know, higher par subs, and also honestly the kind of size that they're looking to, you know, the size of the floating rate trade that especially banks are putting on right now. It's difficult to deal with, you know, what's the availability left after you've seen roller interest and things like that. It's much easier to deploy cash in size when you're looking at, you know, and we've seen most new issue AAA tranches are already pre-placed. That's obviously for a reason. So for those reasons, I think that basis is not as it was in 2018 when new issue refis and resets. And honestly, new issue seems like it's pricing actually better than some of these reset deals.
It's amazingly interesting as a CLO investor, whether you're an equity investor or a tranche investor, the amount of options that you're presented with in markets like these, and how different people navigate these different opportunity sets. I mean, you touch on it great. I mean, we've seen bases between just the curve being too flat. We've seen refi versus reset being flat, not flat, guys taking different positions on, would I rather have a fully ramped, cleaned up reset, or would I rather have a brand new issue with, you know, maybe 25, 30% of rep lines that I'm not really sure what's going to be in there. But very, very interesting time, and always in these markets where you can kind of get you know, you can really kind of take a position as opposed to the more benign markets where sometimes it's just about picking the managers you like the best and seeing how things go. You know, painted a real rosy picture. I think that's been great. I think, you know, let's turn a little bit to the other side of what we learned out of last year and some of the restructurings And some of the things that, granted there were less of them, but I think one of the weaknesses of CLO documentation was a little bit exposed in recent downturns where there wasn't really an ability for CLOs to put new money into some of these restructuring packages. And this had happened even before the COVID crisis, and we had been talking about it. Obviously, CLOs have been responding pretty well and striking a balance between equity, debt, managers, and rating agency concerns. Maybe we start with Pramit on this one. During recent stress, what sort of behaviors did you see out of market participants in kind of your dealings? And how did you see CLO managers respond? What did you think was good, bad? Any kind of insights you can share just from your experience?
Yeah, sure. Thank you, Dan. So I think the life insurance industry in general, the insurers, they do not, maybe now they do, but at least a year ago, they didn't really perceive CLO vehicles as a super actively managed that can navigate through workout restructuring. But I think that perception is changing and for the good. CLOs typically are meant to be a passive loan investor. Typically, but what we saw over last year is, there have been a lot of creative changes in the way term sheets or the loan docs are drafted, right? And also like amendments to the Volcker rule, things like that enabled managers to participate in deals or, not just exit from a particular loan because it has to go through a restructuring. It's a longer hold period. They can't hold equity. It's a higher, it breaches the CCC threshold levels, that kind of stuff. So yes, I think all those are very positive developments for the industry, and the insurers as major investors in these asset classes, they have taken notice of that. So I can speak for my own shop. We obviously own, I would say, a pretty high quality portfolio on the CLO. We did have some exposure into equities and mezzanine debt, mezzanine CLO bonds going into the crisis. But there was honestly no panic buttons. We were in constant conversations with the managers. We are in constant conversations with other insurance-focused asset managers who hold CLO tranches, and it was always an educational process for me sitting in a PMC that yes, managers are taking care of a lot of issues. It's obviously scary and it's uncertain. Like sitting in, let's say last year April, you have no idea how the next 1 year is going to look like. But people were thinking about them. People were running stress scenarios, sector-specific scenarios, stuff like that. So I think a lot of stuff or a lot of amendments really helped. Like I can speak to a couple of those. We obviously talked a lot about the loss mitigation options and rescue financing, in our task force. Maybe we can touch upon that later. There's also the amendments that, even if you buy a loan at a discount, you sort of benchmark it relative to the index versus relative to par, which sort of enables you to not put it into a distress bucket, or use your reserve account to own some of these assets. These are various sorts of amendments which I would say in general, the industry, the life insurance industry feels as, is very progressive. But, I'll just wrap up saying that I think at this point, a lot of the underlying collateral, the loans, the sponsors there are sometimes very sophisticated. And just a percent of the deals which are owned by, let's say, the sponsors or other types of investors, that made it a little more easier. A lot of times, the sponsors were willing to, come to the table with the lenders, including the CLO managers, and they were willing to also, participate in the rescue financing packages, put down equity, and other forms of amendments. So I think the collective effort really made it outshine, and we see the results now in much lower than expected default rates and pretty reasonable recovery for 2020. So with that, I'll wrap up and I'll hand it over to you, Dan.
Yeah, no, all terrific points. A lot of the CLO discussions around putting the language in is about giving the CLOs the pathway to be involved a lot of the times, because you're right, a lot of times the sponsors are actually working in concert with their lenders, and you want the CLO to be part of that recovery. Joe, I know at Carlyle, obviously you guys are out there fighting the good fight for your investors as a CLO manager. And in a lot of these instances, what have you guys been doing to kind of adjust to the changing landscape in your documentation or outside of it? And how have you thought the response has been kind of over the last 6 months to a year? I think you're on mute, Joe.
Thanks, Dan. So, I think over the last year, I think, 2020 will kind of be remembered in part, for all the bad things, but also as maybe the year where CLOs started to defend themselves a little bit from these hedge funds and other, for lack of a better term, bad actors that are involved at times. Going into the year, I would say 95 to 99% of CLOs were completely handcuffed with what they could do in workout situations. Couldn't put new money out, couldn't take back certain securities, and hedge funds and other people capitalized on that. And recoveries were severely damaged. Assets and collateral were taken away from CLOs. Liens were subordinated. Every trick in the book that was out there was used against us. Now I think through some creativity and through some folks out there pioneering with, putting rubber to road and picking up the phone and calling their investor base and trying to marry the manager, equity, and debt investors all together. Now we've gotten a lot more creative, right? We have the permitted equity security concept, which existed a bit prior to this, but now is, in every deal that comes to market. We've also got the loss mitigation loan concept, or, other deals might have it as a restructuring loan, or, call it what you want to call it, but, that's out there as well. Debt investors and equity investors have actually found common ground on sort of the qualified loss mitigation concept, which allows you to even put some principal or interest out and even get a little bit of OC credit for what you're getting back. And so, there's been a lot of doc changes, and, don't want to bore everyone listening here with doc stuff, but what really speaks to me is just how quickly and efficiently all levels of the capital stack came together here to really coalesce around a market solution. Like every new deal coming to market has some form of this. And I really don't think there's any level of the capital stack that's unhappy right now with the outcome. There might be little tweaks around the edges of, hey, you need to run this through the waterfall, or hey, you can't flush this until X is recovered, right? Like those things are fine, but really every player in the CLO product, I think, is happy with the outcome right now, which is rare.
Yeah, it's a great point. And obviously you see how the inside the document mechanics allow these conversations to happen between managers and investors inside the CLOs instead of them being done outside and that value's escaping. Vedanta, how do you think about these sort of rescue provisions and deals that you guys invest in at the AAA level? Are there specific concerns or things you look for, or how have you been able to get comfortable with CLOs, which historically, for me, made this point? I mean, historically, not really used to hold distressed assets. How have you guys kind of gotten comfortable with some amount of holding in some instances?
Sure, thanks, Dan. So, look, I totally agree with the points that Joe made, which is currently almost all parts of the cap stack have become comfortable with the concept of LMOs, issue date individual obligations, or any other construct, specified equity securities, anything else which kind of has come through. But from our perspective, or at least the way I look at it, there are two things which are extremely important. One is, between debt and equity, there should be an equitable distribution of who is putting in the new money and where it is coming from. And the second is the capabilities of the manager to do the restructurings. The concept of LMOs was something which was very common and prevalent in US. It started coming into Europe it came in pretty late. So there were a few transactions in Q2 and Q3, which first came with this construct. There was an Apollo transaction. There was a GSO Deer Park transaction, which first introduced these constructs, and then almost everybody started using it. With respect to my first point, in terms of the capabilities of the managers, in Europe, for example, there are 50 plus managers. And obviously you have some of the big names which have been traditional distressed shops like Oaktree, GSO, Apollo, and they have the capabilities of doing these restructurings because they hold a lot of these bonds across different parts of their credit strategies in distressed credit and create opportunistic funds, etc. And they kind of pool together the whole resources of the firm to do the restructurings. But then you have smaller managers which don't have the capabilities as well. And then the question is, should they be spending their time doing these restructurings when you have a very small team of 4 or 5 people? And should one person be dedicated to being in the coordination committee of these restructurings when his skills are better utilized in analyzing performing loans? From the AAA perspective, it's been, I mean, none of the AAAs have seen any downgrades through the worst part of the crisis. And we know that they can suffer a fair amount of par erosion. So from the senior debt perspective, would I be very concerned if a few of the distressed credits are sold and there's a bit of par loss, which is actually detrimental to equity and not to AAA, and then the portfolio is in good shape? No, I wouldn't. But at the same time, definitely keen to give the tools to the manager to do the restructurings as and when there is a necessity of doing that. So I think that's the first point. The second point is then how should that pain or the rewards be split? And if there is a par erosion, I mean, as senior investors, we will get the money back. It is the equity which will suffer. So there were concepts earlier where, and the typical concept is 10% of LMOs, of which 5% comes from principal, 5% comes from interest, and then you have point in time kind of constructs. And at one point of time in the documentation earlier in the year, the constructs were heavily kind of skewed, or they were detrimental to the debt investors. In some cases, 7 to 8% of the LMOs could be taken from principal, which is not, I think, ideal. So a lot of discussions went on, and now I think in Europe, definitely, we have reached a kind of equilibrium where there is a more equitable kind of, I would say, distribution of how much of the monies can come from principal and how much can come from interest, and how they would be treated in the waterfall, in the OC test, etc. But having said that, look, we are very supportive of these constructs. Definitely, we have seen cases in the US like board riders, Certa Simmons, etc., where the new money was needed. In Europe, there hasn't been any such big high-profile case. There have been a few around the edges, but we will see if they happen. But it's a good construct, but it needs to be handled carefully.
Yeah, no, and great point. Obviously, to do the diligence on the manager and understand how they look at distress and what its value is to them is certainly a great point. Understanding it for any investor, and no, appreciate all those balances. We only have about 3 minutes left, so I want to turn to one more topic and maybe start with Kamal here on it. One of the things that we've been hearing over the last couple of months in U.S. CLOs, which is certainly more pronounced in Europe, which is the implementation of ESG potentially into more of people's investing style. I'm curious, Kamal, how do you think about ESG as part of an investment analysis? And then also, what are kind of the challenges in the U.S. towards, maybe getting to where Europe is, or in thinking about implementing ESG at all in CLO investing?
Yeah, thanks, Dan. So I mean, ESG is definitely becoming increasingly important in the US as well, but we're certainly not near where Europe is right now. And I mean, we can, if we discuss how it affects the CLO space, particularly, I mean, we can, PineBridge is, we're a CLO investor, but we're also a CLO manager. So we kind of, see things both ways. And, from our understanding, CLO investors are not too concerned about ESG just yet. And all the deals that, do claim that they're ESG compliant, I mean, it's just mostly negative screening for industries that, that negative screen has long been, part of the investment process for CLOs anyways. But that's all there is to it so far that we've seen. I mean, there's not much along the lines of positive screenings or publishing your average ESG scores or restricting yourself from investing in a certain level of ESG score, no fives or things like that. And I think there's two parts of the reason. One, like I said, that you're not necessarily getting better execution when you're placing, CLO debt or equity by making yourself CLO ESG compliant just yet. And the second thing is that there is a lack of sort of a standardized framework, that kind of, where you can differentiate between ESG compliant and non-ESG compliant. It's more like voluntary reporting and monitoring and reporting to your investors about how you're tackling ESG. But having said that, I think it's something that's going to become increasingly important. And even if it's not so important to CLO investors just yet, even though we've had some reverse inquiries and questions even from existing accounts that on whose behalf we invest, asking about portfolio exposures to industries and certain credits, for example, Bass Pro. I mean, that never resulted in any forced selling or we've not been restricted or prohibited from doing anything like that. But it's just to kind of show that there's more focus along those lines. But if not specific to CLO managers, I think it's very important to us, at least on a firm level, and it's something that we're trying to accomplish on a firm level. So we're integrating ESG scoring, ESG monitoring into our investment process, because obviously it's all shared resources, and ultimately obviously it's going to translate into more sort of ESG compliant CLOs being issued by PineBridge.
Yeah, no, and all great points. And obviously ESG is becoming more and more important, but it'll be information first, right? People being able to get more information, understanding what managers are doing, and then working through what E, S, and G mean, as you're obviously alluding to in what's really going on is just some amount of negative screening. It's not really a lot of active ESG. So we'll see what happens. I know that the LSTA is working on things like questionnaires, and we're seeing more and more managers providing information. So it'll be an interesting thing to track. I think that brings us to the end of our time. I just want to thank all the panelists. I thought it was a very interesting panel, and I'll turn it over to Caitlin here.
Thank you, Dan, and thank you everybody for joining us today.